Good morning or good afternoon. This is Lauren Speidel from Exeter Trust Company, Exeter 1031 Exchange Services. Thank you all for joining us today. In this presentation, we are going to be discussing unraveling the mystery of purchasing real estate in retirement plans, a discussion about the benefits of holding real property in IRAs, and the tax deferral benefits of a 1031 exchange. I just want to draw your attention to the chat feature of the Zoom or the question and answer Q&A section of the Zoom. Please don't hesitate to answer any question, to submit, I should say, any questions throughout the presentation. We will have a Q&A at the end. And so if anything comes up in regards to self-directed IRAs or alternative investments, self-directed 401ks, or any of the other services that we provide as an organization. We'll also be discussing 1031 exchanges and Exeter 1031 Exchange Services Company that acts as a qualified intermediary. So we'll be really touching on a lot of things. Please don't hesitate to throw your questions in there. Again, at the end, we will open it up for questions and we will review the questions that have been submitted. We also will have our contact information at the end of the webinar. So if you want to reach out to us individually, please don't hesitate to do so. We enjoy having discussions with centers of influence, clients, investors. So definitely reach out if there's something a little bit more specific you'd like to chat about. So first, I'll just spend a minute. Oop, yep. Just introducing us. My name is Lauren Speidel. I am Vice President, Regional Manager, Business Development Officer for Exeter Trust Company and Exeter 1031 Exchange Services. I will be handling the last half of the presentation. I do have my colleague, BDavis, with me today. He is the Senior Vice President for Exeter Trust Company, and he's going to be handling the first portion of the presentation. He oversees the Trust Operations Group and the Retirement and Custody Services Group, which includes the administration of self-directed IRAs, individual 401k plans, private fund custody, and administrative trust custody. He ensures operational execution of Exeter Trust Company's mission to provide clients a means by which to execute 1031 exchange strategies and the ability to buy and hold alternative investments. Brett has served 3 Fortune 500 companies and has focused his entire career on operational endeavors in the financial service space. Brett has been with Exeter Trust Company since 2024, and he'll be covering the first half of the presentation regarding investing into alternative investments with your self-directed IRA. And I will let Brett take it from here.
All right.
Welcome, Brett.
Thank you, Lauren. Thanks to everyone for attending. First of all, I want to make a comment. I absolutely love alternative investments. My career has always touched on them in some way or some manner with variant levels of focus. So alternative investments, I feel, are a viable and important piece of everyone's non-retirement portfolio as well as retirement portfolio. So we're going to talk a lot about alts in this presentation. So a little bit about Exeter Trust Company. So we are a standalone independent trust company. We have a trust company charter through the Wyoming Division of Banking. So that means we're regulated and we have strict oversight by the banking commissioner here. That speaks to safety, that speaks to doing things correctly. We're watched very closely. We also have the typical bond coverage that companies like us have. We have fidelity bond, we have errors and omissions insurance, and we have a blanket bond which covers other errors and omissions. Today we're going to talk about one of our lines of business in the custody operations area, and that is the offering of self-directed IRAs and single participant 401k plans. In the IRA space, we offer the full array of IRAs. We offer traditional IRAs, Roth IRAs, SEPs, simples, inherited, children's IRAs. We offer them all. And we're kind of unique because not a lot of IRA custodians that are pure play IRA custodians offer single Ks as well. We do. Um, we also have another division. We're not really going to talk about these products today, but I like to include them should they pick anyone's interest out there. We have other specialty trust accounts like title holding trusts, land trusts, specialty escrow accounts. We will act as the administrative trustee on personal trusts should they need an administrative trustee. And we also have fund custody business under our belts. So pretty broad as far as the non-IRA business that we do. Okay, I'm ready for the next slide. All right, I want to make some commentary about the state of investing in IRAs and about expertise up front before we start talking about real estate. So the Investment Company Institute, the ICI, some of you have heard about, some of you probably haven't. They strive to gather data on retirement plan investing in the United States. And for quarter three, 2025, the ICI found that 18 billion, just over 18 billion, was invested in IRAs. Now that's great, right? We have a lot of people participating in IRAs. We hear quite often from Congress, from economic forums, from everyone else that we need to invest more in our retirement plans. And I tend to agree with that, but there is an awful lot of dollars in IRAs right now. The interesting factor I found was that 11 million of that is in treasuries, is in listed securities, ETFs, stocks that are traded over exchanges. 8 billion of that is in pure play mutual funds, right? So most of the IRA retirement dollars out there are in listed securities and mutual funds. And that's probably pretty good diversification, right? But it's not perfect diversification. It's never enough diversification. And I want to talk about real estate investors. So real estate investors out there, the serial real estate investors, and we all probably know one or two, are individuals who have properties on the side, right? They may have a retirement plan, but they have properties on the side that they're renting to people and they're generating income. It's coming back to them. They're buying cars with it or they're buying food with it or whatever. But they've done this and they've washed, rinsed, repeated over and over again, buying and selling properties. And they get very good at it. They've spent 10,000 hours maybe doing that, according to Malcolm Gladwell, and now they're experts, right? And we know that experts can find opportunities easier than the rest of us who are not experts in a particular field. So it's important that serial real estate investors or beginning real estate investors or those who serve them, like CPAs, attorneys, fund advisors, um, understand that there's another piece of the world, the retirement piece, that can utilize dollars to invest in real estate properties and real estate derivative investments. And I think that's the disconnect there with the ICI numbers. There's not a lot of people that know you can invest in direct real estate properties or real estate derivative funds and other assets in retirement plans. They're thinking mutual funds, they're thinking stocks and bonds, but not real estate. So that's the population we want to speak to. That's the population I want to reach. So real estate experts. Let's move on to the next slide. What type of properties can you do in an IRA, right? So the IRS doesn't step out there and say, you can do this type of property, you can do this type of property, you can buy this type of property in an IRA. They are very agnostic and very quiet on it. They tell you that you can't invest in a few things like collectibles, like whole life insurance, but they don't get out there and say what you can invest in. So I'm going to share with you what has been permissible in IRAs as far as real estate investing since the late 1970s when IRAs came into existence. So first of all, real property. And when I refer to real property, I mean taking title to an actual property that you can reach out and touch, or or someone lives in, or someone has a business in. This is a real property. And IRAs can invest in any number of types of real properties. Retail dwellings that are being rented for long-term lease potential, or rent and short-term lease potential. For instance, Airbnbs, VRBOs, simple rental properties. Those are permissible and they work in an IRA with some exceptions, which I'm going to share in a bit. Commercial properties, such as strip malls, warehouses, land that businesses are built on. We have clients holding a warehouse. We have raw land. We have a client who owns property that a Dollar General is on, and the rental income comes right into our IRA, and it's very slick. It's a good investment. Um, Raw land for speculation purposes, development, or game and mineral production, right? So raw land can be purchased into an IRA with the intent of just holding it and turning it for a profit down the line. Perhaps someone sees a piece of property out there that people are really hankering to hunt and fish on. You can buy that in an IRA, and as long as the intent is to lease out pieces of it for hunting and fishing, you can do so. The income has to come back to the IRA and has to bypass the owner's hands, but that's a viable piece of property. Mineral production, also a possibility. Um, but I want to say that there's something very important to any investment in real estate. You have to have a process, you have to have a format, and you have to have something that you can wash, rinse, repeat. That's important to all serial investors. And the ones who have been experienced and successful at it for a long time, I will tell you, have a process in place and they utilize that process. They also have tools, which we'll talk about a little later. So that's actual property, the direct investment in real property. You can also lend money out of your IRA. And that sounds kind of esoteric, but you can lend money to an individual who owns a home or a piece of property, and your IRA can take a trust deed against that property as security for the loan. Very flexible investment. Um, in the case that the borrower continues to make their payments, the payments come back into the IRA and grow the IRA. And that's great. Constant stream of income into the IRA. Let's say the borrower defaults. Well, the IRA has the opportunity to take the property at that point. IRA takes the property, rents it out on its own, or sells it for a profit. Very flexible investment. There are risks to it, but it's a viable real estate derivative that can be executed out of an IRA. DSTs, Delaware Statutory Trusts. These are unique investments, allowing individuals to own a piece of a larger property or set of properties, right? We can hold DSTs and IRAs. They're problematic every now and then because they produce unrelated business taxable income. But as long as your IRA custodian can handle that and knows what to do with UBTI and can educate you on it, it's still a viable investment. REITs, real estate investment trusts. Real estate investment trusts have been talked about in heated conversations with love, with hate, with everything under the sun for a long time. In the early 2000s through 2014 or so, real estate investment trusts were very hot. Everybody was trying to buy them, especially in IRAs. Um, they're not as hot now, but they will make a comeback and they are purchasable into IRAs. And I want to make a distinction between two types of REITs and one type of REIT, right? There is a REIT that is exchange traded. It's a public REIT. It's listed. They trade on the markets. You can buy one through Schwab or through Fidelity. And that REIT will move with the markets. If NVIDIA pulls everything down, it's going to pull that REIT right down with it. There are other types of REITs. Regulated private REITs, which report to the SEC but are not traded, and REITs seeking exemption from SEC reporting through Regulation D. These are private REITs. Both are possible investments in IRAs. And I want to comment on the second two in that the argument for purchase of those over the listed REIT is that their price is flattened. They don't move up and down with the markets like a listed REIT does. Very attractive to IRAs. I don't necessarily agree or disagree with that position, but if you look on the internet, that argument is out there. Um, Funds, finally, regulated but not listed, and private funds seeking exemption under Regulation D. There are a multitude of private real estate fund investments out there with variant strategies and variant outcomes. It's a huge world, over 1,000 of them, and they, depending on strategy, might offer adequate diversification to an IRA portfolio that's holding only stocks and bonds. So funds are also out there and a permissible investment in IRAs. So I talked a little bit about, what's permissible, what has been done over time in IRAs and what can be done in IRAs. But there's a couple of problems with real estate investment, and they fall under Section 4975 of the Internal Revenue Code. That code speaks to prohibited transactions. And there's a couple divisions of that code when I think about it. The first division of that code speaks to who you're buying the real estate from, or rather, who your IRA is buying the real estate from. Um, the regulations say basically that your IRA cannot make a purchase of real estate from a family member, nor can your IRA buy it from you, from the beneficial owner of the IRA. Those are considered prohibited transactions. And if you have a custodian who somehow ignores that rule or lets it get through, your IRA becomes disgorged and you pay a lot of penalties on it. It's a very bad situation. So you need to buy the piece of real estate from a disinterested party whom you're not involved with in a family manner. Business is a problem as well, or any other way. So disinterested third party, I want you to remember that. The other piece of 4975 talks about property usage. And it basically says that the IRA owner, if holding a property, an asset, security in an IRA, they should not obtain any benefit outside of the IRA for that property. So here's a good example. Let's say that you found a piece of property in Jackson Hole, Wyoming, right? A wonderful place. Everyone wants to go there. So you buy a piece of rental property there that you're going to Airbnb out, and you're generating income off of it into your IRA. Great investment. Hey, you want to go to Jackson Hole and do some skiing, and you stay in that house. That is an outside benefit to you as an individual for an asset held in your IRA, and that is prohibited. So that type of situation demonstrates what you can't do with assets held in your IRA. And when I think through Section 4975, those are the two important subdivisions for us to consider when we're buying real estate in an IRA. There's a lot of nuances to all of that. And if any of you are coming up with creative ideas for purchases of property and you're thinking it just doesn't feel right in your gut, call me, call Exeter Trust. We'll talk to you about it. We take a very consultative standpoint on all of this. And I will tell you it's a prohibited transaction, or I will tell you I don't detect one at all. We are consultative. We're not afraid to tell you yes or no, and we will help you through the process. And I'll, provide you with thought capital around it. So those are the types of real estate and a couple of the major pitfalls. So next slide, Lauren. Why invest in real estate in your IRA? Why invest in anything in your IRA? Rate of return. So, um, rate of return is the way we measure every investment, right? There's other ways of measuring them, but when we talk about whether an investment is successful or has failed, we talk about rate of return. In 2017, there was a huge study done for the Federal Reserve. It's actually a Fed working paper right now. It was done by a gentleman named Oscar Jorda with a bunch of other people, very smart individuals with a lot of letters after their names. Um, this study it attempted to look at the rate of return on everything, right? From 1870, when data like that started being trackable, obviously in paper form, um, to 2015. And what he found was that there was four subdivisions of asset classes over all those years. They were treasuries, government bonds, equities, which are listed securities, right? Stock in IBM, stock in On Semiconductor, um, and then real estate, actual properties. And as far as average annual return over that broad, long time period, what Oscar Jorda found was that real estate outperforms them all. That surprised some people. Some people, I think, in the real estate world weren't surprised by it, but it was groundbreaking for a lot of individuals who look in at investment in anything. Um, Equities was a close second, around 7%. So real estate was 8%, equities was 7%. And you can make the argument that that's roughly the same. And we can make that argument later in this presentation. But government bonds, treasuries, way low on the rate of return scale, right? So this is important. So this is one reason, amongst others, to invest in real estate in your IRA. Um, Over time, it competes with equities. I'm not saying get rid of your equities and sell them today and go buy a piece of property. I'm saying add to your portfolio, add to its diversification. Lauren, next slide, please. So back to the question, why invest in real property other than just return? Further asset diversification is the first thought. Um, and what that really means is we're looking for assets that don't correlate with one another. And real estate is not correlated with the broader indexes, with the S&P 500, with NASDAQ, with Dow. It's not correlated with those. It moves in different directions at different times. It may move in the same direction sometimes, but it's not correlated enough to even cause a blip on the radar. So real estate offers adequate diversification for any portfolio, retirement or non-retirement. Um, Long-term appreciation we talked about. And then I want to talk about flexibility, which is really variant of outcome. What happens with a piece of real estate, or what can happen with a piece of real estate in an IRA? Well, first of all, you can generate lease income, you can generate rent income, and it can produce a stream of income into the IRA, which grows the IRA's value. Now, if that happens at the same time that the real estate is appreciating, double bang for the buck. Okay, so that is possible. Um, you have tools out there that can be used for the management of real property in IRAs. Airbnb, VRBO. The IRS doesn't say that your property manager can't use those tools to list the property and to rent it out. There are thousands of tools out there on the market to help real estate investors and their managers manage properties. That's important. So, you know, for the last 15 years, real estate seems to have gone up in most communities in the world. And that's viable. To buy and sell is just like to buy and sell a stock. The proceeds of the appreciated property after the sale come back into the IRA and grow the value of the IRA. And again, if you have a process in place, buy another piece of real estate, wash, rinse, repeat. Improve. We have clients who buy properties and they are dilapidated, right? They've been hit by a hurricane in one case. In another case, it's just a rundown piece of property. Their IRA uses its funds to improve the property and sell for a profit. That's also acceptable in an IRA. And I'm going to kind of take a tangent now to talk about the way this has to happen. So any income generated by an asset in an IRA, whether it's a stock listed on an exchange, a promissory note lent out to someone, a piece of property, the income generated by the property has to come back to your custodian. It has to bypass the owner's hands. If it hits the owner's hands in the IRA, it becomes a potential prohibited transaction, and potentially disqualifies your IRA. So rental income has to come back to the IRA. Vice versa. Anything done to a property in an IRA, let's say the roof needs work, you're renting it out, or it needs a new refrigerator, the IRA has to pay for that maintenance. You cannot pay personally for that maintenance. You can make a contribution if your IRA doesn't have the money in it, and then the contribution money that's sitting in the IRA can be used, or you can transfer from other IRAs into that IRA. But you can't use personal funds outside of the IRA to maintain a property in the IRA. So that's important. That flow of cash has to completely bypass the owner of the IRA at all times. It has to go through the custodian, through a property manager. Okay, finally, distribution. So this is more a conversation for retirement age individuals. What do you do with a piece of property in your IRA when you hit 65 or you hit 70 and you need to take a distribution to live on? Property is very flexible. You can sell it, generate the cash, take the cash out as quarterly distributions or all in one lump sum. It's a distributable, reportable, potentially taxable, depending on what type of IRA you have, event at that point, right? It's considered distribution. You can continue to hold the property in your IRA for years after you retire if it's generating income, and you can take those distributions of the income out as it comes in. The one thing you have to consider is required minimum distributions after age 73. There will be required amounts that you have to take out. So if your property is generating enough income at that point, you're in good shape. If it's not, you probably would have to take distributions from other assets or sell the property. And then one thing people often forget about or just don't know about, you can distribute an asset from an IRA. You can take it out into your own name. This can be done with a stock. It can be done with a bond. It can be done with a treasury. It can be done with a piece of property. And it's just really a re-registration event. The title to the property is removed from our name as custodian for the BDavis IRA and retitled into the name of BDavis. It's treated as a distribution. The value of the property at that point has to be pegged, and we report that to the IRS as the IRA custodian. So you get a 1099-R with the value of the distribution, the value of the property on it. But it's a viable option for those who want to take distribution of the property. And perhaps you want to live in it afterwards. Now, that's an interesting comment to some of you probably, because you're thinking, well, Brett, that seems like it's a violation of Section 4975. So it's not, and here's why. When you take a distribution of the property, you can't use it, of course, until it's in your name. When it's in your name, it's out of the name of the IRA, no longer has anything to do with the IRA. Thus, it's not subject to Section 4975 any longer, right? So that's probably the first thought you're having that I hope helps with that. The second thought you're having as well, seems like a prohibited transaction because I'm self-dealing, I'm selling it to myself, right? Not the case either. It's not considered a sale of property. A sale of property would be if you sold the property and the money came back into the IRA. In this case, you are re-registering the property, the title to the property from your IRA's name into your name. So a pure distribution. Always a very flexible event. Um, Finally, I want to touch base again on something that's important with all this. I paint a very rosy picture of real estate and IRAs, and I've talked to you a lot about the benefits. And those benefits are compelling. Um, but you must have a model. You must have tools to use to do this over and over again to make yourself a serial real estate investor. Um, Advertising. In February, we'll be doing a presentation with a gentleman named Johnny Lynham, who is a serial real estate investor and a professional real estate investor. He has developed tools and a process to put in place to help with property selection, determining durability, and just managing the property as it goes. So you'll see invites for that. Think about it. It's a good thing to start thinking about if you're a serial real estate investor already, or if you have clients who are new to this, who may need some tools to help them through the process or help you through the process. Um, Next slide. Okay, what I haven't touched on yet is the thing about real estate and IRAs, which I think is most important. And I tend to think it's more important than average rate of return or what you get when you're said and done with it. Um, I want to go back to the study by Oscar Jorda in 2017. He didn't look at just the United States. He looked at every country that he could get data on, one of which was France. Um, and I want to show you two charts, which are indicative of the same charts for most countries. So these charts compare two things. The red curve is a public listed real estate security investment or set of those index in each of our two countries. So that's traded securities that are invest in real estate, right? The green curve is real estate, real property out there, um, and based on the return of the real property. When you look at the red line, you see a stock chart, right? It goes up and down. It's jagged. Price movements are crazy, um, and it looks just like a stock chart. Right? So that's my point with listed securities. They move all over the place. The green bar is smoother, right? It looks like rolling hills. It doesn't move as hard as the listed security does. And that's because the big players in any market pull the others along in the direction that they're going with the same amount of momentum. So back to my earlier example, if NVIDIA goes down 200 points for no reason someday, it pulls the rest of the market down with it. So I want you all to remember that about real estate and the point that I just made. Next slide, please. And that point speaks to volatility. Volatility is everything, especially when you're taking a distribution from an IRA and thinking about selling an asset to fund that distribution. What if your asset is down 200 points that day and you need to sell it? Well, you're selling at a loss and you're getting less money. So listed securities can be problematic from that standpoint. If they're high flying and they're in great shape, wonderful. But again, they go up and down. So real estate has less volatility. And what Oscar Jorda found was that real estate has the same level of volatility as a corporate bond. And when you think about the way we approach corporate bonds in this world is as safe investments. Bonds are safe, treasuries are safer, right? But that's the way we approach them. Um, Real estate average volatility from 1870 to 2015 was 10% compared to listed securities, equities, stocks, and companies at 24%. Wow, right? So I'm going to step back. And if I buy a piece of real estate, this is telling me that I'm buying something with the same potential average return of an equity with far less volatility. How is that not a win-win? So, anyways, this is from the Jordan study, and it was a statistic that surprised everyone. The volatility associated with real estate for IRAs is very key because if the sales price moves up or sideways or down, slower than everything else, you have a better opportunity to plan for your retirement and to plan when you sell and distribute monies. Okay. So a lot of flexibility with IRAs as far as price movement and decision-making potential with IRAs. Okay, next slide. Okay, I've talked a lot about direct investment in real estate, and I talked a little bit about funds, but I want to also talk about funds in detail. Real estate funds are important because new investors to real estate may want help. They may want a professional manager to do this for them while they learn. They're also important to serial real estate investors because they can add additional diversification to the portfolio, right? So if you're good at it and you're buying and selling properties and you park, some of your portfolio in a professionally managed fund, that could add diversification. Perhaps that fund is a triple net lease property fund and you're buying raw land. Diversification. So further asset diversification is, one of the potential benefits of private real estate funds. Again, real estate is not correlated with the traded public markets, and that goes for real estate investment funds as well that are not listed. We're talking Reg D funds, private funds. They don't move with the markets. I want to make the point that non-correlation with markets is not the same as durability. You heard me use durability earlier. Durability is really quality, the quality of investment and the expectation of investment. Will that investment return income when expected, in the amount expected, and as expected? Will it appreciate as it expected? Will it depreciate as expected? That's durability, the prediction ability for a property to behave as expected. Okay? Non-correlation and durability are two different things. So again, because a real estate fund is not listed, it's not subject to violent price movements like NVIDIA, my example of NVIDIA pulling down the entire market with it. It remains a little more stable. And again, just like a piece of real estate in the IRA, the stability affords the IRA or the person's manager to help them figure out when's a good time to sell. Professional and engaged management of the fund. This is important. So not all private real estate funds are rosy. They're not all great. You will have to explore the fund manager, become comfortable with their strategy. I always recommend speaking to them directly. And if they speak to you, that's good. If they don't, it's bad. But discuss with them their strategy. It's important to find the good managers from the bad managers, just like the good stocks from the bad stocks in the market. So not every real estate fund is great, but you do have the ability to have a manager, an engaged manager investing in nothing but real estate, right? So what does that do for the portfolio? Well, back to the diversification word. It adds diversification. All right. Real estate funds, I mentioned thousands in count out there, private real estate funds. Huge variety in type and in strategy focus, right? So you can have real estate funds investing in only triple net lease products. You can have them investing in raw land and then flipping the land later for a profit. You can have real estate funds that invest in raw land and then develop it or partially develop it. The strategies and the focus are as creative as the manager is creative, right? So lots of creative models out there. And then finally, this is the piece of the real estate fund argument, which I think is most important. Autonomy for the fund manager. Right? When you think about one of the public mutual funds at Fidelity that you can go into, or Janus funds, those fund managers are subject to some things. They are subject to their prospectus. They have to adhere to it to the T, to what that prospectus says. If it's a fund that invests in only triple net lease properties or only equities in the S&P 500 and they stray from that, they're in trouble, right? They could be sued. Um, they are constantly under fire by investors. They are constantly having to defend themselves to analysts. They are constantly having to defend themselves to board members. Private fund managers don't have that kind of distraction. They don't care what the markets are doing out there. Nvidia's not pulling their price down with everything else. They don't have a bunch of shareholders calling them every day, complaining about an investment they've made that didn't produce. They are fully autonomous and focused on their craft. And I think that makes for a very good manager. Again, there's bad managers. You got to figure out who the good ones are. But when you get a good one, they are focused. And I want to leave you with a quote. Sam Zell, one of the greatest investors in real estate of all time, probably one of the greatest investors of all time. Very salty individual in language and life, though. But he said something that is really telling. And he was in the process of taking a company he had bought private. And he said, just by being private, the culture will change. The culture will change. We won't be forced to make decisions that are 90 days in relevance. And what Sam was saying was that I don't have a bunch of people knocking on my door all the time, distracting me from running this company and making it a great company. I'm not being pulled down by the markets. I'm not concerned about what the markets are doing. I'm concerned about one thing, the investments this company has and selecting the best ones. So that's a great quote from Sam Zell. And I think when you find a good real estate fund manager, that's the kind of attitude you're going to have. All right. I want to thank you all for listening to me today. As Lauren mentioned, there'll be a Q&A at the end of this. Um, and I'm going to turn it over to Lauren for a good conversation about the other side of our business.
Thank you, Brett. I appreciate that. A lot of good information. Again, if you have any questions, please don't hesitate to put them in the question and answer section of the Zoom. We will definitely get to them at the end of the presentation. I am going to jump into another line of service that we provide here at Exeter. So just to give you a little bit of idea of the Exeter group of companies, we do have Exeter 1031 exchange services, which began in 2006. So over 20 years of experience being a qualified intermediary for 1031 exchange transactions. We also can act as an exchange accommodation title holder, which allows us to do some of those more complex transactions like um, reverse improvement transactions. With that, Exeter Trust Company, the inception was in 2019, and there was a number of reasons why we began Exeter Trust Company. One was to provide other lines of service for our real estate clients. So land trusts, self-directed IRAs, self-directed 401ks, specialty escrow holding accounts. Those are all things that the trust company does. It also provides a qualified trust account for every single exchange client. So when we talk about the safety and security of your exchange funds when you are doing a 1031 exchange, this is something that's extremely important. It means that your funds are legally protected. They're not commingled with any client or corporate funds. And so Exeter Trust Company is the part of our company that creates those trust accounts. Excuse me. So for anyone who is not familiar with 1031 exchanges, it is an IRS code called Section 1031. And it's a tax deferral strategy that allows an investor to sell investment property, so something held for investment purposes, as long as it's real property. And as long as you had that intent to hold it for rental income, appreciation, or use in a trade or a business, it should qualify for Section 1031. And in order to do a 1031 exchange, you need a qualified intermediary, which is an independent third party, sometimes also known as a 1031 exchange accommodator or QI. Those are terms that we might use interchangeably here. You may also want that qualified intermediary to be able to act as an exchange accommodation title holder in case you want to do some more complex 1031 exchanges. So most of our exchanges are forward 1031 exchanges, but we also do reverse 1031 exchanges, improvement 1031 exchanges, and also foreign property 1031 exchanges. We can administer 1031 exchanges in all 50 states. And we'll go a little bit further into these transactions towards the tail end of the presentation. But again, if you have any questions, you can reach out individually or through the chat feature. So just a little bit of history on 1031 exchanges. They've been around for over 100 years. The Revenue Act of 1921 created Section 202C, and that allowed investors to exchange securities and non-like-kind property, and it was really to spur economic growth. The Revenue Act of 1924 eliminated the ability to exchange non-like-kind property. So personal property would have to be exchanged for personal property. Real estate would have to be exchanged for real estate. In 1935, the Board of Appeals approved the first modern tax-deferred like-kind exchange using a qualified intermediary. So again, an organization like ourselves. In 1954, they officially amended the federal tax code to Section 1031. So that's where the term 1031 exchange comes from. And for the most part, even prior to it being a code in the IRS, you saw people barter for livestock, they'd barter for land. So these types of transactions were very commonplace. And many times when people would do exchanges, it was usually all done at the same closing table on the same day. They would sell and buy within minutes or hours of one another. There was one specific case called the Starker case. It was the Starker versus the US. And it really changed the 1031 industry forever. In the late 1970s, TJ Starker, which was a timberland owner, sold his timberland to a paper mill company. And over a series of 5 years, he would trade in the units that he received. And that's one of the requirements that someone does not take receipt of the funds. And that goes into a few slides. Um, but he traded in units for properties, and then he filed his exchange. The IRS disqualified his exchange. He paid the tax, but took the IRS to court for 4 years and eventually won. And that really changed the 1031 industry forever. It really explained that you did not have to do a 1031 all in the same day or within hours of one another. You can use time to help find your replacement property. In 1984, the IRS came out and said, here are the delayed timelines for a 1031 exchange. You don't have 5 years. You have a total of 180 calendar days, with the first 45 days being your identification period. In 1991, the IRS came out with additional regulations outlining safe harbors for qualified intermediaries. So it has to be an independent third party. It can't be someone who's provided tax or legal advice to that taxpayer in the past 24 months. So while we are consultative and we'll let clients know if we see any risk, we unfortunately cannot provide tax or legal advice to our clients when you're doing a 1031 exchange. And then in 97, the Taxpayer Relief Act clarified that domestic and foreign property are not considered like kind. So I mentioned we do foreign property exchanges. Foreign property is like kind to other foreign property. If you are selling in the US, you would need to buy in the US. Revenue Procedure 2037 provided guidance on structuring reverse 1031 exchanges. And I'll go into a little bit of that in a few slides. And then in 2017, personal property exchanges were eliminated. So prior to the Tax Reform Act, someone could be selling livestock and be buying livestock. They could be selling artwork and be buying artwork. You would have companies like Enterprise or UPS doing personal property exchanges with their fleets of cars or their cargo planes. But in 2017, they did eliminate personal property exchanges. And the only type of exchanges that currently now qualify are real estate exchanges. So transactions that involve real property. There are a number of taxes that you are deferring when you are doing a 1031 exchange. Now, when you have your primary residence, you usually will qualify for Section 121. Section 121 allows you to sell your primary residence as long as you've lived there 24 of the past 60 months and you haven't used that exclusion in the past 2 years. And you're able to exclude $250,000 of gain if you are single, 500,000 if you're married. So that's a huge benefit for owning a primary residence. But investment property doesn't have anything to do that to exclude income. It has something called Section 1031, which allows you to defer your tax liability. So it is a wealth building option for investors. They typically have more money to reinvest into another property. When someone sells an investment property and doesn't do an exchange, and let's say it's not held in an IRA, most people are in a situation where you've got about 30 to 40% in taxes off of the gain. And the gain isn't all taxed at the same rate, but you've got depreciation recapture at 25%, long-term capital gains rate, as long as you've owned it over 12 months, would be between 15 to 20%, and then possibly state tax. You may also be subject to the Medicare surcharge at 3.8% if your income is high enough. So with a 1031, you're deferring that tax liability, and instead of paying the IRS those taxes and then reinvesting, you're really getting the opportunity to use all of your cash proceeds to reinvest into another property, maybe a larger property, maybe a property located in a different area, maybe a different sector of real estate. That's basically the biggest benefit, one of the biggest benefits of the 1031 exchange. It's important to keep in mind that as I explain the exchange, I'm really mentioning tax deferral. It's not tax free. So if you were to trade up and keep doing exchanges, and eventually you decide, I don't want to do this anymore. I'm just want to sell and pay the tax, you are going to see tax liability. You're going to see gain from even your first property. So that gain rolls over to the next property. And so you might see a significant tax liability at that time. Sometimes people decide to do it when they're in a retirement age. And so maybe their tax liability might be less. The threshold of percent of tax may be less. But really, the biggest benefit is to exchange throughout your life. So you're keeping the wealth in your family. When you pass away, and this isn't anything anyone really wants to talk about, but when you pass away, your beneficiaries receive a step up in cost basis. So that means that your tax liability goes away and your beneficiaries start fresh with a brand new basis. So if I were to pass away today and I have all this real estate, and let's say it's now worth $2 million dollars, and my children inherit that, their basis is 2 million. So if they sell it for 2 million, they have no tax liability. So it really provides a wonderful generational wealth builder. We always recommend checking with your estate planning attorney to make sure that your assets are held in a way that give that benefit, so that it can be involved in your estate plan. Now, to be mindful when you are deciding to sell an investment property, I always recommend consulting with your accountant or CPA to determine what kind of tax liability that might be. In some situations, if you haven't owned it for very long, or maybe you've put a lot of capital improvements into the property, it may not make sense to do a 1031 exchange. So it's always good to, of course, have that discussion with your accountant. They can run the numbers for you to make sure that it makes sense to do a 1031. And when you decide to do the 1031 exchange, we need to be assigned into your sale before closing. So the settlement statement would need to show us as a qualified intermediary. It's not when we receive funds, it's prior to the actual settlement date, the closing date. We are going to draft the necessary 1031 exchange documents. We are going to securely hold your proceeds in that qualified trust account I mentioned. If you take receipt of the funds, that will disqualify the 1031 exchange. Even if you're holding the check and you haven't deposited it, the fact that you closed without a qualified intermediary is going to disqualify the exchange. So we help advise and help structure investors, 1031 exchange transaction. We want to know all about your transaction to properly let you know if you might have some risk. And when I talk about risk, the risk is that if you were to be audited, and they decided to review your 1031 exchange, if they saw something that didn't sit well with them or doesn't fit into the requirements of a 1031 or regulations of Section 1031, they could possibly disqualify your exchange, which would mean that you are now responsible for the tax liability, interest from when it was due, And the wild card is if there's a penalty. The qualified use requirement is extremely important. It really means that investors must have had the intent to hold the relinquished property and the replacement property for investment purposes. So again, that's rental income, investment or appreciation, use in a trade or a business. Property held for sale typically will not qualify for a 1031 exchange. So if you're a fix and flipper, that's not going to qualify for Section 1031. Condo conversions, where you're really changing the structure of that property. So rental units to condos, we would recommend after that conversion, holding it for 12 to 24 months to prove that your intent to hold was there. And then if you wanted to sell, that may work. And property acquired to develop. Usually developers don't qualify because they don't have the intent to hold a property long term. Their goal is to buy property, develop it, and sell it. Now, keep in mind the IRS understands that intent can change. You could be a fix and flipper and decide the market's not right to sell. Now I'm going to go ahead and rent it. Now, if you've got fair market value rent on your tax return for 12 to 24 months, that's proving that you had the intent to hold. So there are always scenarios where intent may change. Keep in mind, and this is a pretty simple slide here, that real estate is like kind to any other type of real estate. As long as the qualified use test is met, as long as you had the intent to hold it for investment purposes, it should qualify. Again, personal property was eliminated in 2017 with the Tax Reform Act, so that will not qualify under Section 1031. We get the question all the time about if I'm selling a single family home, do I have to buy another single family home? The answer is no. You can buy any type of real estate. So multifamily, commercial, retail, warehouse, vacant land, timberland, vineyards, oil and gas interests, mineral rights, water rights, air rights, fractional ownership in a tenant in common structure or Delaware statutory trust, which Brett mentioned earlier in the presentation. Those are great for people who don't want to actively manage real estate anymore. So just keep in mind again that real estate is like kind to other real estate. Non-like kind property. Your personal property usually doesn't qualify. Second homes and vacation homes typically don't qualify. Most of the time when people call us, they've been using that property for months at a time. There are times where second homes and vacation homes can qualify. And so we'd want to know if there was any personal use with the property that you're selling so we can see if it does qualify for Section 1031. Again, property held for sale. So conversions, developments, fix and flips. Securities, so cash, stocks, bonds, mutual funds, and REITs. If you own that and you don't own it in an IRA, it will usually have tax liability when there's a sale. Partnership and membership interests, LLC interests, and shares in a corporation. And I know in some instances an IRA can hold some of this, but if you just own it outright, keep in mind that the taxpayer that owns the real estate is the taxpayer that needs to buy the replacement property. So if, for example, you were selling a property and you wanted to buy LLC interests, you're really buying personal property, and the owner of the real estate is that entity. So be mindful that LLCs can do exchanges, corporations can do exchanges, but those entities would have to sell and those entities would have to buy. If you're just a member in those entities, you own personal property, which again wouldn't qualify. It's not real estate. Total exchange period, which gives everyone heartburn, is 180 calendar days to buy your replacement property, but you have 45 calendar days after your sale to identify what you might be purchasing. So if you closed today, day one would be tomorrow. And keep in mind, these are calendar days. So weekends, holidays, your birthday, Christmas, that all counts towards your 180 days. So usually clients might want to start looking before they sell. You can put in an offer, you can sign a contract, you can do all of those things. But you would have 45 days to formally identify what you are purchasing. And when you identify, you can't just list 100 properties. You have to be really specific and you have to choose an identification method. Most people choose the 3 property rule. That allows you to identify 3 potential replacement addresses. That may not mean you're buying all 3. It may mean you're only buying 1, but you're giving yourself 2 other opportunities in case that first one falls through. If you wanted to identify more than 3, you could, but you'd be restricted by other other scenarios, other limits. You could use the 200% of fair market value rule. 200% of fair market value rule means that you can list as many properties as you want, but you do need to list what you would pay for those properties, estimated fair market values. And we would total up those values, and it cannot exceed double what you sold. So if you sold $1 million property, you'd have $2 million to work with. Let's say you list 4 properties, each for 500,000. That would work. Again, your goal may not be to buy 4 properties, but it does, in this scenario, give you the opportunity to list more than 3. Usually works best if you're cutting up the funds into multiple properties. The 95% exception allows you to identify as many properties as you want, but you've got to close on 95% of what you've listed. So we see this the most if you close within your 45 days. Maybe you are buying a portfolio and you know you're buying everything within that portfolio. This option could certainly work. And this is something that we can discuss with you, the investor, the client, figure out what it is that you want to purchase and kind of walk you through what options you have. We would need that identification form by 11:59 p.m. your time zone on your 45th calendar day. We'd recommend sooner than that, but that would be the last time that we can accept an identification form. If you do not identify, then you're telling us you're not moving forward with the 1031. We'll release the proceeds to you, and that would be a taxable event. Reinvestment requirement is often misunderstood. It basically means that you must have the intent to reinvest everything into your new property. You usually want to trade equal or up in fair market value based on the net sales price. Net sales price is the gross sales price, so the agreed upon price between the buyer and the seller, minus routine closing costs, broker's commission, closing agent fees, notary fees, wiring fees, average transaction fees. And the IRS has a list of them. We also have it listed on our website. You want to reinvest all of your cash from the sale, and you also want to reinvest the debt amount. And I'll have an example in the next slide. You can always add cash to the transaction. You can replace that debt with cash, for example, if you don't want to take out another mortgage. But if you were to take some cash out, that would be a partial exchange. And you can do a partial exchange, but just be mindful that the amount that you take out or the amount you don't reinvest would have tax liability or may have tax liability. So that's really where you want to check with your accountant to see if you're subject to that. You might have something to offset it. So an example here is, let's say you sell a property for $530 and you have $30,000 of closing costs. Your net sales price is $500,000. The mortgage left on it is $250. That mortgage is paid off at closing. The other $250 comes to us. We're going to hold it securely for you in your qualified trust account, and you will have to reinvest all of the $250 that we're holding and buy for $500,000 or higher to have a fully tax deferred exchange. If there's a difference in this, let's say you buy for $470, that $30,000 not reinvested would have tax liability. Even if you reinvested all of the cash, you could have tax liability on your debt. So this is, of course, something you want to be aware of, especially if you're doing a partial. We always recommend checking with your accountant to see what that means for you tax-wise. Kind of already went through this. The partial exchange is okay. It doesn't harm the overall 1031. You can always obtain a larger loan. But if you're taking any cash out, that would cause a taxable transaction. Now, what I just explained was your forward exchange, sometimes called a delayed exchange. We also talked in the beginning about TJ Starker and simultaneous exchanges and how people would sell and buy within minutes or hours of one another. That's called a simultaneous or a concurrent exchange. This is most of the exchanges that we do. You sell first, you buy second in that order. There are also exchanges called reverse 1031 exchanges, and this is where that exchange accommodation title holder agreement is important. There's a parking arrangement in place. So you buy first and you sell second. It sounds fantastic, but there are a lot of hurdles. Lending is a hurdle. Sometimes people will call us and say, I've already bought my replacement property and now I want to sell my relinquished property. If we're not assigned into that purchase, you've disqualified the exchange because you can't own both properties at the same time. There is also a build to suit or improvement exchange. And that's where you are purchasing a replacement, but you want to use some of your funds to make improvements on that replacement property. That can be done, but also involves a parking arrangement. We're going to prepare an exchange accommodation title holder agreement, which will park title to your replacement property. We're going to hold it for you because you're not done using your exchange proceeds. Again, there's more to that. Lending can be an issue. Um, it can be an issue. The cost of these transactions are much more expensive. And then foreign property, 1031 exchanges. Really, it covers all of the requirements that we just discussed. The like kind, though, is foreign property. The US is, of course, the 50 states, the Northern Mariana Islands, the US Virgin Islands, and Guam. Surprisingly enough, Puerto Rico is considered a foreign property. So, same requirements, just that you'd have to be selling and buying foreign property. So these are most of the exchanges or most of the structures that we do. And with that, we are going to leave it for some questions. Now is a great time to add any questions you might have into the Q&A. If you have a chat feature, you can also add it there. And Brett, there are some questions that have come up. One question is, how do I finance a piece of property in an IRA?
That's a great question. So financing is tough to do with IRAs, to tell you the truth, all right? But it's not impossible. Um, so financing has to be done through an entity, a bank, a private lender, individual, that can offer a non-recourse loan. Non-recourse loan meaning that the bank or entity can't, come after the property held in the IRA if you default on the loan. A lot of banks obviously won't do that for clear reasons of risk. However, some will. And some private lending firms will as well. And what I found throughout time is that it's more about the relationship you have with the private lender or with the bank. If you have substantial assets out there with the bank over here in a trust account, maybe they'll agree to do it because you've demonstrated that, you're a solid client. Um, so good question. You have to find a non-recourse loan.
Okay. Um, can I buy a property I already own in my IRA?
No.
Okay.
So So that
Answer.
that it's a good question, right? And everyone should ask that question if you're thinking about it. Section 4975 of the Internal Revenue Code prevents IRA owners from using their IRA funds to buy properties that they or their family already own. It refers to the process as self-dealing, and it's prohibited. So you can't do a property that you own already, or that your wife owns, or that your kid owns.
Got it. Okay. Um, and I know that there's some other questions that are coming in, but I'm going to try to tackle the IRA questions first, just kind of for simplicity. Can I buy a property with another person or even myself and hold as tenants in common? Is that possible? Sometimes there are situations where someone doesn't have all of the funds in their IRA and have to use funds from, a partner who also wants to own a part of that property.
Sure. So that's a great question. It goes kind of hand in hand with the question around the loan, right? If you can't get a loan, well, how can you purchase a property that your IRA fully can't afford? Um, Properties can be bought in a situation where the IRA buys 40% and another individual out there owns 60% of it. The tricky part of it is the deed. How is the ownership of that plot of land or that house or that property expressed? It has to clearly delineate between the IRA's ownership percentage and the other individual's ownership percentage. And that's doable, right? If you have a good attorney who's on top of this, they make sure the deed gets filed correctly and in the right proportions. The other tricky part of it is, if it's income producing property, what happens with the rents? So the rents have to come back to the individual that owns the other piece and to the IRA in pro rata amounts. So 40% of the rent would have to channel back to the IRA, with the other 60% going to the other individual. Um, for that, you need a property manager dropped in the middle, someone other than the client, the owner of the IRA, who can, make sure that that money goes to the IRA and to the other individual cleanly, bypassing the IRA owner's hands. The other tricky piece of it is the sale of the property, right? Both sides have to agree, and then proceeds have to go back in pro rata amounts. So very possible. Now, when that other individual is you, some custodians will do it, some will not, because it's so close to a prohibited transaction. We would do it with all those other factors in place properly, but
Mhm.
we would also ask that you get a letter from a CPA or an attorney saying, I've reviewed this transaction and it is not subject to any of the prohibited transaction rules under Section 4975. So we would ask you to get that additional protection for yourself as well as for us.
Got it. Okay. And I understand in some cases, a real estate investment might produce UBTI. You mentioned it in the beginning of the presentation, but can you explain what that is exactly and how that works with the
Yeah.
IRA?
Yeah, that's a great question. It's also a tricky rule. So I'll kind of tell you the definition of UBTI, and then I'll give you a couple of examples. So the definition is income earned or generated by a tax exempt entity or account, tax exempt account in this case, the IRA, um, from activities that are not related to the accounts or the organization's um, purpose, core intent, right? So things that the IRA, the asset in the IRA does that really aren't within the scope of the IRA's intent. All right. The IRA's intent is to grow retirement money over time, right? To invest in assets that do that. So, so here's a good example. And UBTI, it doesn't come into play with just one type of real estate asset or the other. It's all of the real estate derivatives, I think, with the exception of the promissory notes. I don't see how it could come into play with that. Um, so let's say your IRA invests in a piece of property, right? And it has a business on it, and the business happens to be owned by the IRA too, right? Which kind of gets into prohibited transaction rules as well. But the business generates income because it's a business and it returns it to the IRA. That is outside of an investment. That is running a business in an IRA. And the intent of the IRA is to grow itself through investment, not through revenues generated by a business it owns. So that's UETI, and it expresses itself as UBIT, which is the tax that will hit your IRA. Should that occur, your custodian has to pay taxes out of the IRA to the IRS, and you end up getting a Form 990T from the investment, right? That's how you know if you have UBTI involved. Um, Another example is oil and gas. Um, Oil and gas outfit, you own a partnership interest or an LLC interest, and the oil and gas outfit lends or rents its equipment to another entity for rental income. And that comes back into the LLC, and thus the LLC makes a distribution to your IRA, and some of that would be UBTI because it's outside the scope of the normal business. Um, so yeah, it's a complicated rule. But if you're going into real estate other than direct ownership of land or rental income, it's probably something to discuss with your custodian, making sure that they can handle it, understand it, and quantify it in your account easily.
Thank you. Just a couple more questions, and then I've got some exchange questions I'll tackle. Um, do we review investments for clients slash investors, review or approve?
Yeah, so we don't necessarily approve investments. We do take a look at them closely and review, and we will tell you if it looks like a prohibited transaction. That's basically trouble for you and trouble for us. So we will decline to hold that investment.
Okay.
What we really don't do like a due diligence review around performance. So if you're going into a real estate fund, we don't look at the feasibility of it returning what it's saying it's going to return. We leave that to you. What we would look at it for is, well, are there future capital calls? Are there future calls for cash from your IRA, right? You're funding at 50% up front, and then there's, a series of four calls throughout time. Are those calls going to deplete your potential to make a contribution to the IRA? If so, that's some risk to your IRA, and we would bring that out to you. You would have to demonstrate to us, of course, that you have substantial IRAs elsewhere and you can transfer money in, or the calls would have to be small enough that you could make contributions. So things like that we look at. We call it administrative feasibility. Can we administer the asset for you? Can we handle the flows of income that it gives us? Um, that kind of thing. Operational review.
Okay. And then the big question that we get all the time, what are our fees?
I will tell you, we are the best looking custodian on the street for keys. Um, $275 per year. That's it. We don't have transaction fees. We don't have holding fees. We don't have closing fees. None of these wire fees that other houses charge right and left. $275 per year. We cut it up quarterly, so you pay basically 68 bucks a quarter. That's it.
Okay. Well, thank you so much.
Yeah, thank you.
I'm going to dive into some 1031 exchange questions that we got. And I'm going to start with some easy ones, and then I'm going to jump into a little bit more complex question. Um, Number one, to clarify, if you identify three properties within 45 days, so you've completed your identification form, you've chosen, let's say, the three property rule, can you purchase only one if the numbers work? Yes. Ideally, that's typically what we see. We do most of the time see people wanting to trade equal or up in value. Uh, there are clients that do end up taking funds and spreading them amongst multiple replacements, but I would say most of our clients are selling one and buying one. But when you identify, maybe you have to reinvest 500,000 and you list three properties and they're 500,000 and above for each of these properties, you really only need to purchase one of those. So you do not need to purchase all three. If the numbers work, you can just purchase one of them. That is totally fine. If you want to purchase two, you can. So you can decide how you want to spread those funds. Um, there's also a question to clarify the 200% rule. So I'm just going to go into a little bit more detail. When you receive the identification form from us, the first page asks you to choose an identification method, and there are three methods. So again, the three property rule is the first one you'll see. That is the most commonly used. It is also the simplest. The second identification method is called the 200% of fair market value. So you would have to know what you sold your property for, and you would take that number and multiply it by two. So if you sold your property for $1 million, you multiply that by two, you're at $2 million. So if you choose that option, when you start completing your form, there's a section where you list the addresses. And it will ask you for the fair market value of the properties you're listing. It'll also ask you if you're buying 100% of the property or if you're buying a portion of it, because there are sometimes people who only are buying a percentage of a replacement property. Maybe they're buying it with someone else. Maybe they're buying a Delaware statutory trust and they're really only buying a sliver of that portfolio. But the fair market value that you list there is what you believe that you can purchase that property for. And then you would need to add up the values of all of those properties and total them. If your numbers in this scenario exceed 2 million, you're probably going to get a phone call from us or an email saying you have surpassed the 200% rule. You've exceeded $2 million, which is your limit. So you have to pick a different identification method. This is one of the reasons why we usually recommend that people submit the identification form before 11:59 p.m. on their 45th day, because it gives us time to give you some feedback and let you know if you don't fit into the identification method that you have chosen. If, for example, you chose the three property rule and you list five properties, we've got an issue. So you've got to choose a different identification method. But if you submit it at 11:59, all of a sudden we get an email and it's timed 11:59 and that same scenario occurs, there's no way for you to amend your identification form. So now you've got a problem. You've got an identification form that doesn't fit the requirements. Um, and I'll clarify the 95% exception as well. The 95% exception allows you to list as many properties as you want. So let's say you list 10 properties. Let's say that you list $100,000 value for each property. You think that you can purchase each of these 10 for $100,000. Your requirement now, if you choose the 95% exception, is to buy $950,000 worth of those 10 properties. So if for whatever reason you're able to negotiate a much lower um, cost on these properties, let's say now you can buy them for 800,000 instead of 950, you have a problem because you have not uh, purchased 95% of what you listed on the form. So this is where we come in. We want to be able to help our clients. Not all qualified intermediaries will review identification forms. They will time and date stamp it, sign it, and send a copy back to the client. If given enough time, we will review it to make sure it fits one of those identification methods, specifically the one that you've chosen. And if it doesn't, you're usually going to hear from us. Um, There is a question about an LLC. So if you have a three-member LLC that owns a property, can one member 1031 exchange their share while the other two take sale proceeds and be taxed accordingly? That's a difficult one. And that is because it's hard for investors to understand that they own personal property, they own membership interests in that LLC. The LLC is a living, breathing taxpayer. If that LLC is a partnership, it most likely has an EIN number. It's filing a 1065 tax return. It's providing those members K-1s. And so those members are reporting those K-1s on their tax return. Uh, that LLC to the IRS, again, is a living, breathing taxpayer, is the true owner of that real estate. And so ideally, it would be best for that LLC to sell and that LLC to buy. That would be I don't want to say a riskless exchange, but that would conform to the requirements of Section 1031 as long as that LLC had the intent to hold the property for investment purposes. We do come across situations where members maybe aren't getting along or they don't want to move forward. They want to pay their tax. That's where we're going to have a discussion with the taxpayers and figure out what might be the best route for them. You may hear the term drop and swap. That's a term that's used quite frequently when we're talking about 1031 exchanges. We have had clients do them. There is risk associated with drop and swaps. And so, as we all know, everyone's risk tolerance is different. So those investors would have to be comfortable with the risk. Let's say that a drop and swap is done. So let's say it is an LLC partnership and they basically drop the property out of the entity and amend the title to reflect um, each member as an individual owner. Now at closing, you've got three members that own as tenants in common, and a tenant in common structure, each member can do their own thing. The risk is that the individual that is doing the exchange, if they were audited and an auditor wanted to review the exchange, they could say that they just became an owner of the real property when the quitclaim deed was done, which may have only been a few weeks prior to the sale. And so they could argue that that investor did not have the intent to hold. They owned membership interest and then they owned real estate when the quitclaim deed was done. And so proving that you had the intent to hold that real estate may be hard if there's already a purchase and sale agreement in place or there's already discussions about a sale. With that being said, I do have clients that have done them and they feel comfortable with the risk tolerance. It's kind of an individual decision. We also have seen people do redemption agreements where they might add someone in to the LLC and then remove two of the members as tenant in common owners so that the LLC is still live, but the membership of that LLC changes. And so when the sale takes place, let's say they all owned 33%, the LLC is still a partnership because there's two members. If it ever triggers single member status, that can be an issue. But when that is done, the LLC then owns 33%. It's still a partnership because there's two members. And then the other two individuals own is 33%. And when they sell, it would be a tenant in common structure. The LLC would move on to do the exchange. And we would recommend holding that LLC for at least 12 to 24 months before any changes are done to title or to that entity. Now, keep in mind, this is discussed if the LLC is a partnership. If it's an S Corp or C Corp, it may be very difficult to remove members. It might even cause a taxable event. So doing that at that point may not make sense to do the 1031 exchange. So as you can tell, 1031 exchanges are complex. You're going to need proper guidance. And this also goes with self-directed IRAs, individual 401ks. So we are available should additional questions come up. Um, right here on this page, you will find my direct contact information at the top. Below that, you will find our national headquarters information. You'll also find Exeter Trust Company's information. So if you want to get a hold of Brett, that's a great number to put in your cell phone. And then these QR codes are great references. The quick reference guide to self-directed IRAs. This is a virtual version. We do have hard copies. If any of you guys want hard copies, let us know. It's a trifold. And then the quick reference guide to 1031 exchanges is one of our most requested marketing pieces. It also is a trifold. It covers just the main requirements for the exchange, so it's not too complex where you might have your head spinning on either one of these marketing materials. But we also do have that in hard copy. So if any one of you that are on the call would like this in hard copy, definitely feel free to reach out. We can get them over to you. I'm going to throw one more suggestion. If you do have any more questions, feel free to throw them in the chat or the Q&A area. Otherwise, you can reach out to us independently. We'd be happy to help. I'm going to give it just a couple of moments to see if there's any additional questions. And if there's not, we will certainly wrap up. Yeah, it looks like we don't have anything else. For those that did submit questions, I want to thank you. That certainly helps when you're doing a presentation to have just additional thoughts and questions come to mind. But if you do have something that you'd like to discuss independently, again, please don't hesitate to reach out to us. And I want to thank Brett for joining me today. I'm hoping to have these on a quarterly basis. So if you get an additional invitation down the road, please don't hesitate to jump on. Please feel free to forward it to other people that you think might benefit from learning about alternative investments and self-directed IRAs or 1031 exchanges, maybe specific clients you might have. But again, you can always share our information directly with them as well. So thank you so much, Brett. Thank you all for joining us today, and we appreciate you. Thank you.